Thank you, Rick. Thanks, everyone, for coming. Really appreciate you taking the time to listen to what I have to say. As you mentioned, I'm just going to talk a little bit about the economy and the market cycle, and where we are now, how we got there, and where things are headed. I won't talk as much about specific investments, although feel free to ask questions about that at the end as well. But in order to really kind of understand where we are right now in the economy, in markets, it's important to take a look at where this entire cycle started. And so for that, I'm going to have to take us back. A couple of years, back to 2020. Put my glasses on, do this right. Okay. So the reason I'm bringing us back to 2020 is obviously, that's when the pandemic started. And so if you'll remember back in early 2020, the stock market was all-time highs, the economy was firing on all cylinders, and it seemed like we're going to have a pretty good year. We knew that in China they had another SARS outbreak. It was something that had come to the fore in 2019. 15 years prior to that, there had been a different SARS outbreak, which was mostly contained to Asia. But once markets realized not only was it going to escape Asia, come to the United States and become a pandemic throughout the world, markets reacted pretty quickly. And if you'll remember back in that time, within less than 6 weeks, the stock market dropped 34%, the credit market seized up, and then even the Treasury market started to malfunction. And clearly the Treasury market is how the United States finances its debt. So the Federal Reserve felt compelled to intervene, and they did it in a very, very big way. And not only that, they were able to act much more quickly this time than they did from the global financial crisis. Because back in the global financial crisis, they didn't have the playbook, they didn't necessarily have all the legal authorization, but this time around they did. And so they intervened, the market hit a bottom, and then ended up going for up for the rest of the year. Credit markets normalized, and Treasury markets did as well. And so it seemed like, okay, things are getting back to normal. And so, what I talk about a really big intervention, I want to put that into context. And the way I can do that is showing, the Federal Reserve's balance sheet. So what you want to see here is just this huge, big jump up, and these are, trillions of dollars. So you're talking about, a Federal Reserve that, say, since the beginning of the 21st century, had a little less than $1 trillion on their balance sheet, which is a huge amount of money by anyone's standards. But if you look at the GDP of the United States, the size of our economy, it's around $22 trillion. So at that point, it's still a relatively low percentage. The global financial crisis happened. They put in around $3 trillion into the economy, into markets, and they did that over around 12 years. And actually, they were starting to take out some of that stimulus off their balance sheet, out of the economy, out of markets, heading into COVID, prior to COVID. Then the pandemic hit, and then they intervened. And what I really want you to notice is not only the magnitude of what happened, $5 trillion, but also how it happened in such a short period of time. Really, in like 1 or 2 years, you had $5 trillion going into the economy and markets, which is clearly unprecedented not only in terms of the scale, the magnitude of how much they put in, but over such a short period of time, comparatively speaking. So that's one thing that happened. The other thing that happened is the federal government intervened and put $2 trillion into the economy through various government programs. And so the point of this graph, and I know it's pretty noisy, but the idea is, if you benchmark to the end of 2019 and just kind of go straight across, and then look percentage-wise, consumer income, what's happening with consumers on average throughout the country. The green line shows kind of the trend line that was happening before COVID. And then you can see the light blue bars, which represent salary income, wage income you would get from working. And as you'd expect in the beginning of COVID, that was negative. There were people who were laid off. There were people who lost their jobs. We all remember it was mostly in travel, hospitality, things like that. But on the dark blue bars, you see kind of transfer payments. So that's Social Security and Medicare, which you always have. But a lot of it had to go with COVID stimulus, extended unemployment benefits. And so what you get is the red line, which is what actually happened, versus the green line. And so as far as I know, this is probably the only recession that we've ever seen where people ended up, on average, with more money after the recession ended than before it started. I don't know of that ever happening before. And so again, like I mentioned, there were plenty of people who lost their jobs, who lost their businesses. It's not that everyone ended up better off, but on average, the American consumers, the amount of money that they had in their pockets to spend was higher than where we started. And so you ended up with, again, $2 trillion from the federal government, $5 trillion from the Federal Reserve. That's $7 trillion in an economy that's $22 trillion large. So that's a huge percentage. And if you think about it in terms of the United States. So, what happened, and we all know what happened, it led to inflation. And that's kind of where Rick was given the preview. And clearly that's what's different about what's happening right now and what's been different over the last couple of years is just this really big spike in inflation. And you can kind of see that over here on the right side of the chart. For the two decades prior to 2021, 2022, inflation was in a pretty low range, maybe 0 to 2%. And even 10 years prior to that, maybe it was in a range of 2 to 4%. But what we saw in 2021, and then continuing a little bit into last year, you really have to go back into the late 70s and early 80s to see inflation of that magnitude. And that's clearly the big story. And I'm not saying anything that you wouldn't already know, but in hindsight, looking at all the intervention that was done, it does seem like that was an inevitable consequence. And there's no free lunch. Even though the stock market bottomed, things seem like they're getting back to normal. Clearly there is a price to pay, and we all know it all sitting here, especially if you're seeing the costs of everything you're doing increase. So the Federal Reserve, dealing with inflation for the first time in really around 40 years, they have really only two mandates. Legally, there's only two things they're supposed to care about. They're supposed to care about price stability and full employment. And so for the most part, price stability, the idea that there's relatively low, stable inflation, they haven't really had to worry about for many decades. They've typically been involved with the unemployment. As we all know, if you go into a recession, unemployment spikes, they end up lowering interest rates, and then they try to just get the economy to heal on its own. Really their main tool, and they have a few tools, is interest rates. And sure enough, with an inflation spike, the first thing they do is start raising interest rates. So, prior to 2020, the interest rates, weren't very high, but they were above zero. They went down to zero. They held them there for a long period of time. And there's a lot of things I think you can give the Fed a free pass on in terms of, the amount of intervention they did was huge, and it seems like a lot. But first of all, they didn't know how long the recession was going to last. They definitely didn't know whether or not the federal government was going to assist in the problem, because in the global financial crisis, the government took a lot longer to do fiscal stimulus, put money into people's pockets. And when they did, it was a much smaller amount. And then lastly, how would the Federal Reserve know that in a very short period of time, they'd have a vaccine in less than a year? And that clearly was the turning point to getting the majority of people back out and living their lives as normally, regardless of what we saw in the South, where we had better weather and people weren't as worried about it. But if you look at the larger population centers, people really were voluntarily staying away from public places. And then once the vaccine came out, things got a little bit back to normal. But the idea is that the Federal Reserve really raised interest rates very quickly in a short period of time and very, very high. And so for the Fed, they didn't really have a choice in terms of what they could do. Really, their only way to respond to inflation is raising interest rates. Now they can decide how high to raise them, how long to keep them at those high rates. They can decide what trade-offs they want to make between higher interest rates and an inevitable recession and unemployment, and that's something that I think they're grappling with right now. If anything, and we'll talk about it a little bit later, it seems like everything is working according to plan at this point. And so, my job typically is to worry about all the things that can go wrong. When things are going well, that's great, but that doesn't make me sleep well at night. I think about what can go wrong. But ultimately, you have this reaction of the Fed just raising rates so quickly. And so, as you're seeing this domino effect, all of the intervention, then the inflation, then interest rates being raised, then what happens? Well, inevitably, that's going to hit stock prices. And so you can see as we kind of zoom out and we look at, let's say, 2020 through 2023, and really remembering last year, right? So 2020, we had that 34% drop. Things got back to normal, back to all-time highs. 2021, we built on that. And then 2022, we all remember last year, that big drop in the stock market. And so, that is the inevitable, reaction to higher interest rates, and the stock market will key off of that, and the bond market will key off of that as well. But I think it's really interesting putting things in perspective, right? Look at these last 3 years, and there's two things I point out. One is, if you look at the worst possible case, where we were, the lowest we were, let's say back in October of 2022, if you look at that, not only is that well above where we were at the lows in 2020, it's actually higher than where we were at all-time highs before COVID. So on the one hand, the market went down quite a bit last year, but yet the level that it went back down to is still higher than where we started. And so I think that's kind of an interesting thing, right? Because last year we weren't feeling like, okay, we had made a lot of money and then lost a little bit. It really felt a lot worse than that. I think it felt a lot worse than, okay, well, even now at our lowest point, we're higher than we were at the all-time highs before any of this started, before the pandemic started, before the Federal Reserve had their reaction to it. And so if you think about it, why is that? Why did it feel so much worse than potentially it was from a stock market point of view? And I think part of the answer is, all of us, for the most part, are going to own stocks and bonds, right? It's not just what happens to your stock investments, your equity investments. It's also what happens to your bond investments, your fixed income investments. And actually, if you look at the combination, so let's say, a 60-40 portfolio, 60% stocks, 40% bonds. Not everyone's going to have that, but that's a pretty typical portfolio. It's one that's pretty widely studied and kind of shows the trade-off between stocks and bonds. If you look at that portfolio and you just look at the average across all accounts, if you look at what's happening with your entire account, well, actually, back in 2022, last year, it's actually the third worst outcome in around 75 years for them combined. And so for things to feel really bad last year, it makes a little bit more sense. Really, it's only the global financial crisis in 1974, during a previous bout of inflation, that the combination of the two have done so poorly. And so I think that's worth knowing about and thinking about when you say, okay, last year, even though the stock market went down a good amount, why did it feel so much worse than maybe it otherwise would? And that's because it was bad. It was, third worst in 75 years. And so I think that's also important to kick into context. So I've talked a little bit about, things that have gone, things that have been really challenging, things that have been, a little bit of a kind of a negative. And I wanted to end the presentation before I open things up to questions, either about the presentation or anything else, with two slides that I think potentially are more of a positive note versus what we've been seeing so far. So this particular graph, or this chart, what it's trying to show you is just where consumer sentiment is. So basically the idea of just measuring how do just people feel in general. Maybe they're thinking about their stock portfolios, their bond portfolios, they're thinking about their housing price, the price of their home. Maybe they're thinking about just even their own employment prospects. In general, how are they feeling? And that feeling of either positive or negative will drive consumer spending decisions, it drives investment decisions. And what's really interesting about this chart is every single time we make these lows, and again, this is going back 50 years, every single time we hit these lows, when people feel like they feel worse about their finances, they feel worse about everything, the actual forward return 12 months later is always really good, 22%, 20%, 29%, et cetera. And conversely, every time people are feeling great, for the most part, returns are either negative or relatively low compared to the other side. And so if you think about it, it does make sense, right? If you're feeling really, really bad about things, it doesn't take that much for you to feel better. So whether that's the idea of, everything you could think of, right, could go wrong, even if things are less worse than you expected, that's a positive, right? And so, people forget, the stock market's not this magic, mathematical computation. It is driven by people. It is driven by emotions. It is driven by, how people feel about the future. And sure enough, not only is that the case where things can be less worse than expected, the other thing is the stock market is always operating on price, right? So if things really are gloomy, if things really are bad, prospects don't look good on the horizon, a lot of times that's in the price. When prices are low enough, you can either go up a little because things aren't quite as bad as expected, or you can go up a lot as things get back to normal. So there's a kind of that opportunity for reversion to the mean. And sure enough, last year, right in the middle of last year, we were down across maybe the lowest points that we've seen in the last 50 years. And sure enough, we've had this really big market reaction this year, which has been so far has been pretty positive. And so it looks like, at least for now, that trend is continuing. So we'll see what happens. But I think, again, a silver lining to all the doom and gloom about high inflation, about high interest rates, about all the things that have been happening on the negative side, there is potentially a silver lining from an investment point of view, even if truly things economically are a little bit bleak. And then one last slide I'm going to leave you with. And again, the point of this is just look at the colors. That's all you have to do. And it's going back about 5 years. And so the idea is these 6 different categories, and you don't necessarily need to read them if they're too small to read, but these are the actual 6 categories that the government agency that's responsible for saying the start of a recession, end of a recession, the National Bureau of Economic Research, they'll actually say this is when a recession started, this is when it ended. It looks at these 6 different categories. And you can just see color-coded, red are things going decreasing, green are things increasing, and then in between. So either darker shades of red, darker shades of green, green being more of an expansion. And so I think it's really interesting. You can see right away, right here, March 2020, April 2020, right across the board, all 6 indicators, absolutely, we had a recession. It was probably one of the quickest recessions we've ever had. It was extremely deep in terms of economic output loss, but it started and ended within almost 2 months. And so that's what happened in 2020. And you could say, the pandemic and the government-forced lockdowns caused that huge drop. And whether or not you believe the Federal Reserve itself or the confidence that came from the Federal Reserve or other events that happened, but clearly we had that V-shaped bottom and came out of it. The point of showing you this is, despite the fact over the last few years we have had certain categories go red, for the most part, as you look kind of going forward, we've never had anything like this so far. And for the most part, you're seeing green, different shades of green, maybe some yellow. There are certain categories that potentially are flashing a little bit of a warning sign. But we don't have anything at all very consistent showing that we're heading into a recession. And so, you would think inevitably with interest rates going higher, with that being a cost for businesses, for people trying to buy homes, eventually, we are going to have a recession. But it's interesting to see that despite all of the fact that despite how much the Federal Reserve has raised interest rates and everything that we've been through, all of the main categories really are not showing signs of recession at this point. So that's one more probably positive thing I would say is despite everything that we're seeing in terms of all the headwinds, despite all the negative news that I'm sure everyone's reading, we still aren't quite in recession yet. And so for that reason, that's another reason to stay probably a little bit more optimistic than you otherwise would if you were just reading the headlines. So with that, that's kind of what I wanted to show in terms of just kind of showing kind of where we're headed. And so for me, really the risks that lie out there right now are, inflation has come back down. That's a good thing. And I think if the Fed can get inflation back down to 2% without us having an increase of unemployment, that would be a fantastic thing that they achieved. I'm still a little skeptical that they'll be able to do that. I do worry that one of the things that probably keep me up at night are the fact that sooner or later, with interest rates as high as they are being held at a long period of time, there may be a delay, right? All of that extra savings that people had, they're starting to spend through that. Could be true that a lot of people are kind of content staying in their homes, but at some point, as you're forced to move and you have to get a 7% interest rate mortgage as opposed to a 3% or 4%, that's going to be extra cost. That's going to impact either how much of a house you can buy or how much disposable spending you're going to have. Likewise for corporations. Corporations were pretty smart this time around, to the extent possible. When interest rates were really low, artificially low because of the Federal Reserve, they went ahead and termed out their debt. So 5 years from now, 7 years from now, 10 years from now, they have pretty low rates. But if interest rates stay high for a longer period of time, they're going to have to refinance at higher rates. So I do think there are some risks in terms of going forward, higher interest rates. But to me, as an investor, part of the things I worry about is just making sure that you have those inflation hedges in the portfolio, things that can help you in the event that inflation stays higher, and also being careful on the fixed income side of things, the bond side of things, making sure that if interest rates stay higher for longer, being a little bit more cautious, not just assuming you can go back to investing the way that you could for the 30 years prior to what we're dealing with. It is a little bit of a different environment. And the point of that slide that I had showed you with stocks and bonds together, everyone I hear talking about, making presentations for the most part, they'll talk a lot about the stock market, and it is probably the most important part of your portfolio. It's the part that's most inflation protected. It's the part that probably can grow the most and give you that nest egg that keeps going. But the fixed income part of your portfolio is really important as well, both as a source of kind of ballast and keeping things not quite as volatile when the stock market is really going up and down, as it will from time to time, but also generating income. So for those of you who are taking money out of your portfolios, clearly, well, not clearly, I would say one of the secrets to being a really successful stock investor in addition to being diversified, is thinking about that stocks are very volatile, right? And so to the extent that you don't need to take money from your portfolio, from the stock portion of your portfolio, when prices are lower, all things being equal, you're going to end up with a much better result. Having some fixed income, having some bonds in your portfolio that you can take out either for regularly scheduled distributions or unexpected needs of your money, that'll actually protect the part of your portfolio which is in equities. And that's really how you can compound growth over time, is making sure you're never a forced seller when prices are low. Because no one knows when prices will go back low. We just know for the most part, if you have a really well-diversified portfolio and the United States keeps doing what it's been doing for 200 plus years, hopefully business eventually will kind of get back to where they were and continue. So I think I'll stop there. I'm not sure if there's any immediate questions from the audience or about the presentation or anything else, but yeah. Yeah, that's a great idea. And it's live, I think.
First of all, let's give Chris a round of applause. Really good job. I'm going to lead off with the first question, then we go to Frank, and this is time to learn. So I heard you about the bond market and possibly shifting to fixed income, just something that's less volatile. What's the first 1, 2, 3 steps that someone might take in this room when they're considering shifting more to a bond perspective?
Sure, and I think, again, the idea that bonds should be part of your portfolio, I would assume that for most people, they already are, right? And so Rick and the team, as they're putting together your investment portfolio, a certain amount is going to be in equities already, a certain amount is going to be in fixed income or bonds, and that will change over time. Typically if you're younger, you have a longer time horizon, you're willing to take on more risk, maybe a higher percentage of your portfolio would be in stocks and less would be in bonds. But also the reverse is true, to the extent that you either want to preserve income more, have less fluctuations in your portfolio, maybe you're taking more income out of it. So my comments were more along the lines of, given that you might have the right amount of stocks or bonds already in your portfolio, and again, Rick and the team will not only set you up with the right allocation, but change it over time as the circumstances in your life change. My comments were more along, how do you pick and what should you be picking within those bond portfolios? And so I think most people have a pretty good understanding of the stock market, at least at a high level. You kind of, you see the Dow Jones every day, or maybe the S&P 500. Different companies that either you've worked for, or friends or family have worked for. You understand on the equity side of things. But on the bond side of things, there's so many different things you can invest in. You can invest in U.S. Treasuries, you can invest in corporate bonds, debt of corporations. But there's mortgage-backed securities, structured products. There's lots of different things, and so, from what I've seen of a lot of people's portfolios, and again, that would be across other investment managers, there always seems to be a desire amongst people to really get as high a return as possible, as high a yield as possible. And so that's all well and good when the economy is doing well, but if the economy is going to go through a downturn, the last thing you want is your stocks to go down, which they're going to go down no matter what, and have your bonds go down as well. So being a little bit more careful about being a little bit safer, and safer can be the credit risk you're taking, so maybe either a better investment grade company or a U.S. Treasury, and then also looking at your duration, how long those bonds are invested for. And that's something that you shouldn't necessarily have to worry about. It's something that your investment manager should worry about. So in that context, I would say maybe a shorter duration, not necessarily lending money for as long, and then having better credit quality, which is kind of what I meant.
Awesome. Great answer. Thank you.
Thanks, Chris. The last 2 years, did we have a recession with 2 quarters of negative GDP? Does it matter? But then how do we look forward to that? Usually recession means a 7 to 10 year growth cycle after that recession. So how do we mix that all in with sort of looking forward for the next decade?
Sure. And that's a great question. Have we had a recession? We've definitely had some periods of slower growth. So far, they haven't declared a recession in terms of looking at all those different 6 indicators. The idea that you'd have 2 quarters of negative GDP growth, that's a good rule of thumb. That's something that I've always kind of used as a rule of thumb, but that's technically not what determines a recession or not. So technically speaking, we have not had a recession. However, in some cases, it's felt like that. What's interesting is during that COVID period, right, there was just 2 months. Not only did we not have 2 quarters, we didn't have a single quarter of negative growth, or we had 1 quarter if you include 2 months negative, 1 positive. But it absolutely was a recession because it ticked off all those results. What I think a lot of people are thinking about is, when is the recession coming? When's it going to happen? And so I think most people are surprised. I know I'm surprised, given how much the Federal Reserve has raised interest rates, how many headwinds we have in the economy, and yet unemployment has stayed low. People continue to spend. Consumers have been very resilient. So that's been surprising to me, and I think probably to most people, because if you listen to a lot of people forecasting when things are going to happen, it hasn't happened. What I'm starting to think about and starting to hear from some people is, well, maybe this time, because we had the artificial lockdowns, everybody was stopped from spending for the most part. Now that people have a chance to spend, maybe even make up for lost time, they're doing some of that. Maybe we're not going to see a typical business cycle where you just go through a classical recession because of either excesses or speculation, and then you come back out of it. Maybe what we've been seeing is what they call like a rolling recession, the idea that certain parts of the economy have been in recession. So we all saw what happened to housing. It was terrible for that short period of time, and then it's been amazing. And likewise, that's happened in other industries as well. So it's possible that because we're having almost this rolling recession phenomenon, we won't see everything at once. And so that just makes it much more challenging as far as investing, but it also makes it harder to predict, what will the business cycle be. But it's a great question, and that's probably as much insight as I can put onto that.
We'll follow up. So savings rates, what people have in their accounts right now.
Sure.
Is there enough fuel to continue to cause an expansion, increase in the market?
So, I think the idea that people are investing, putting more of their money into treasuries or to cash and things like that, that's often a contrary indicator. Oftentimes, when people run out of cash, when people are taking great risk, that's when you have the most chance of kind of that meltdown in the next recession. And we're not really seeing that. For the most part, it's almost as if people don't want to believe what's happening. And I can understand that thought because it's counterintuitive. You think the Federal Reserve raises interest rates, eventually we go into recession, and that still may happen, but the fact that it's taking so long is different. And so I think, again, it's not necessarily the fact that there's so much cash that we should worry about. If anything, that may be the reason why the stock market goes even higher than we're currently expecting. But good question. Thank you.
Who's got the next question? Great. Richard.
I just have a question. I want to ask about precious metals.
Okay.
And I listen to the radio a lot, and I've noticed so many more commercials about it, which immediately makes me skeptical. But what's your take on that? Is that something good to do, especially when the economy is having a difficult time?
Yeah.
Or not?
Yeah. Well, first of all, I've noticed that as well, and I love your reaction. That's exactly the way I think, right? When people are selling it the most, when they're pushing it the most, that's probably a time you should just, kick the tires a little bit more, kind of look into it. And so it's interesting. I've had clients over the years who've said, I really believe in gold. I'll invest a little bit in the stock market. I'll invest a little bit in real estate, but I really, really trust gold. And so I went back and looked at it. I don't know if any of you, read Warren Buffett or hear what he says. He hates gold. He talks about gold being one of the worst things you can do with your money in terms of, he's like, you're basically digging something up from the ground, then you put it into a vault, and then you just watch it. And so on the one hand, you get his point, because he's saying, all right, if you have money in a farm or you have money in a business, you have money where it's compounding, right? It's earning interest, and or you're investing in something where you can have higher returns, which is what he does, and he's fantastic at it. That should be superior over time. On the other hand, you have to look at the fact that gold has been around for 5,000 years. It has preserved to some extent your purchasing power, and most importantly, it's outlasted every empire that we've ever seen. So I don't want to say there's no reason to have gold, but I would say, in general, just looking at, let's say, gold versus the S&P 500, and that's a pretty narrow index, but large cap U.S. stocks. I went back and I looked at that because I was talking to a client a couple of years ago who said, I really don't trust the stock market. I just want to put my money in gold. And I looked, and if you picked the absolute bottom in gold before the 1970s inflation and then took it through to the present, the S&P 500 still beat gold, and that's the best period gold's ever had. So it does seem like Warren Buffett is right, and that's the case. So here's what I would say. If you head into an inflationary environment, it is good to have something that will maintain its purchasing power. And it can't just be stocks. You need to have, like we said, you have stocks for a certain purpose, you have bonds for a certain purpose. What I found was really interesting, and I looked into this extensively even a few years ago because I was worried about inflation just based on the spending and things that had happened. And I found that actually energy in general, just either the energy commodity, oil, natural gas, like things like that, or energy companies actually over prior cycles, including in the 1970s, have outperformed precious metals. So it's not wrong to think about commodities in general in an inflationary environment, but there are actually other asset classes or other sectors that are actually a little better. So I would say, for anyone who loves gold and they want to have a piece of it, by all means, I'd never tell anyone don't own any. But in general, that's something that would be, a very small part of your insurance plan. If you truly want to have purchasing power over a longer period of time, you're going to need that combination of stocks and bonds. And typically, stocks have, for the long run, have done better. So that's why I focus most of my energy on the equity and fixed income markets with some investments in commodities, especially the last couple of years. That's one big change that I made, was having more commodities in my portfolios, and specifically energy. But great question.
Great answer. But gold is shiny.
It is shiny. It is. So are diamonds.
Very well balanced answer. Who's next? Great.
Thank you. Thanks for the presentation. Thanks for worrying about things. And thank you to Rick and the team for worrying on behalf of investors. I'm curious if you're worried about the resumption of some of the student loan payments. Rent forbearance was a thing during COVID.
Mm-hmm.
You highlighted the kind of the normalization around income and inflation, but some of the expenses might get a step function increase. And have you quantified that, or do you worry about it?
Right. And that's a great question. I think, for those of you who have not been following closely, the idea is that a lot of student loans were just kind of put on pause. They not only was there a freeze in interest rates, they actually didn't have to make payments back. That's going to be starting up again soon, where people who have student debt are going to have to pay back those loans. And I think it's definitely a factor, right? It's not something you can ignore. It's something that matters. All things being equal, it should take away from discretionary spending across the board. What I would say is, if you think about it, the majority of spending power, the majority of disposable income that's being spent is typically happening, with people who are older than that, right? So you may have student loans for 20, 30 years, but even in that case, probably your loans are a lot smaller. Where I think it's going to affect most people is in their early 20s, late 20s, early 30s. So again, within specific companies, within specific brands, within specific spending categories, it'll have a larger impact. I don't know that in and of itself is what's going to push us into recession or really cause a problem, because the majority of spending is 70% of the economy, I think, happens outside of that. So yes, it's a factor, but I don't know that it's as big a factor as people would like you to think when they're trying to come up with a headline that's scary.
Thank you.
Mm-hmm.
Great question.
What keeps you awake at night?
What keeps me awake at night? Well, coffee, yeah. I would say, at least, in general, I'm always worried about, do we have the right investments for the right situation? What's going to happen in the future? What could go wrong? I would say specifically right now, I do worry that although inflation has come back down, which is great, it may not come all the way back down to target. And I think there is that risk that the Federal Reserve either raises interest rates more, which I don't think they want to do, or keeps them higher for longer, which is something I think they will do. If you kind of think about it, if the Fed has to fight inflation, and if they keep raising interest rates, it's definitely going to cause a recession. I think there's some hesitation. You're seeing that already, that they already feel like they've raised rates enough. On the other hand, there were a lot of people, even as recently as maybe even a couple months ago, that said Federal Reserve is definitely cutting rates this year. And that's because they think we're going to have some kind of a crisis and the Fed's going to run to the rescue and cut rates. And they've specifically talked about, in the late 70s and early 80s, where the Fed made that mistake. The Fed basically raised interest rates, we had a recession, they lowered them, inflation came back, and then Paul Volcker had to bring interest rates to 18%. They definitely don't want to do that again, and they've talked about it. So I think, all things being equal, if they have to make a mistake of cutting rates too soon or keeping them too high for too long, just from like a behavioral psychology point of view, I think they're going to keep rates too high for too long. So that's something I've worried about. And you guys haven't seen it yet because we haven't been working together on an investment point of view. But fixed income bonds this year, at some point they were up 3.5%, and then they were down to almost flat or negative again this year. And the fixed income portfolios that I've been running have been 2.5% to 3% and climbing for all years, which is not a huge number, but 3% versus 0.5% or 3% versus 0 is meaningful. And so by being safer, not rushing into just buy bonds because they were down last year, I think it's been helpful. So I really try to think about all the different things that can go wrong, what's most likely to happen, and then try to position accordingly. And that's how I can sleep at night, because I try to use diversification and just looking out for kind of risk factors.
So our current political environment that we're coming into, how does that play into the upcoming market into 24? I was hoping you were going to say, oh, does that play into it or not at all?
I mean, I've over all the years that I've been doing this, I always get questions about either party in power, president, things like that. And without a doubt, every single president that has their own executive actions and every single Congress which passes laws, in the short run, they always have an impact on either various sectors, various parts of the economy. But in general, if you look at the stock market over the last 100 years, let's say, American companies always seem to find a way to kind of adapt to whatever the current situation is, and those great companies just continue to not only survive but thrive. And so I try not to think too much about politics in terms of an investing purpose. I will look a little bit short term. What are areas to maybe hold off on, or what are areas to look for where you'll get better prices? But for the most part, I have never made a decision about, we have to get very, very cautious or we have to get very, very aggressive depending on who's leading in the polls and or who wins, because that's typically not been a good strategy. There's no really data to support that. So hopefully that answers your question. Yeah. Mm-hmm.
Great. Who's next? Questions on that? You got a question? Sure. You're allowed to ask. Anyone here? Great.
I've read that REITs are doing well, but yet brick and mortar buildings, stores are hurting. So what's the future for REITs?
Yeah. So the question about REITs, real estate investment trusts, it's a really big category, right? As most of real estate is. And so if you kind of break it down into component parts, people really started worrying about, malls, buying things in person when Amazon came out back in the 90s and early 2000s. And so what we did find was there were certain types of categories of real estate that really did take a hit and never recovered. Now what people are talking about is more probably on the office side of things. Okay, people work from home 5 days a week during the pandemic, maybe because they were forced to. A lot of people really liked it. Now there's a lot of flex time. There's a lot more of people wanting to work remotely. And so there's kind of two things happening in that area. One is a lot of CEOs and a lot of people who are running companies either feel like the productivity is not as good when people are home all the time, which may or may not be true. And I bet you if you look at it, it depends on the type of work that you're doing, and it probably depends on how much training you've already had. If you're someone who's experienced, been doing something for 20, 30 years, I bet you're really productive at home. Someone who's brand new, who's not getting on-the-job coaching, isn't learning the culture, probably is lost. And so I think there's already starting to be kind of that idea that there's a lot more return to office now and in the near future than people were predicting just 2 years ago. So maybe things aren't as bleak as you think on the office side of things. But I think going back to kind of that mall or that shopping example, what we saw was the most popular, the ones that had the best brands, the best experience, things that had things other than shopping thrived and did well. Those things which were just your average strip mall in a bad location, which lost their Sears or lost their anchor tenant, kind of went out. And so I think you're going to see the same thing with office. I think Class A office space in New York City, in highly desirable areas, are going to maintain their value and they're going to be okay. And then other either not as good quality properties or not as good locations, desirable locations, probably will lose. So I think it's going to be a mixed bag. I think in general you're going to see REITs kind of continue to do well in the short run as you start to see those defaults, as you start to see kind of the implications of those lower quality or lower, less desirable locations start to lose their value. I think you'll see that REITs in general will start to lose money or will start to lose their value, but there's always going to be pockets of the real estate market that I think are going to still do well even through this cycle. So that's probably my non-black and white answer.
Thank you, Wes. Good question. Chris, so we get the opportunity to go to a lot of conferences and things, and so we're at a conference last fall, and everybody's mind is on potential recession. And then we feel like maybe the rules change as far as definition of recession last year. So could you comment as to what are the actual rules of a recession? What defines a recession? And then also, why did this year, when we had predictions of a recession happening this year, why did it kind of get pushed down the pipeline? And it looks like we might even be free in 23 year of a recession.
Sure.
So.
Yeah, no, that's a great question. And I think that's something that's kind of, captured a lot of people's, discussions, ideas, mind share. So in general, there had kind of been this rule of thumb that if you have 2 quarters of negative GDP growth, that's a recession. And that's kind of the rule of thumb. If the stock market goes down 20%, it's a bear market. And so if it's down 19.9, it's not, but 20.1 it is. It's more of a rule of thumb, right? So in general, people had typically said most recessions are 2 consecutive quarters of negative GDP growth. But that's not the official definition. Literally, that committee, that National Bureau of Economic Research, they look at those 6 categories, and a group of economists decide, and they always do this 1 or 2 years later, so they have perfect hindsight, and they pick the exact time of the top and the exact time of the bottom. And so, a recession will actually be officially designated, in a look-back basis. But probably the more important part of the question is, well, what about this recession that was supposed to happen this year and isn't happening? And I think the key to that has to be just the resilience of the consumer. And so it's interesting, right? It's very cyclical. If consumers continue to spend and companies continue to make money, then they don't need to lay off workers. On the other hand, if you lay off workers, then those people don't have money to spend and things can't keep going. So every single business cycle has followed some type of pattern. They're all different, but there are similarities between them. But ultimately, something is going to have to break first, and we don't know what it is. And it is possible, maybe that tip of the iceberg is the student loan thing. Anything's possible. We've seen stranger things. If you remember back in 2007, everything was booming, and then it wasn't, right? And no one really knows what's the straw that breaks the camel's back. At some point, we just know that all expansions eventually end and a recession begins. And so the key, I think, to us not having a recession this year is absolutely the strong consumer. And so whether the strong consumer is because companies are holding on to workers longer and therefore less unemployed people means there's just more spending in general, or maybe there's just more excess savings out there than we thought based on everything that happened during COVID. People saved their money or there was government transfer programs. But for whatever the reason, as long as that continues, we're not going to see a recession this year. And so, as we're into August already, it looks like, that recession call probably does need to be pushed out a little farther. So, great question. All right.
Hey, 2 things.
Okay.
We talked about risk-free rate of return, 3-month bill, where it was 0, now 5, something.
Yeah.
But also digital currencies. Should any of us have a concern about the possibility of digital currencies in the future and how it would affect companies, investments, and so forth?
Sure.
There's
Yeah.
a lot of interest in that.
Yeah. And it's interesting when you say, digital currencies, right? Because a lot of people were talking about like Bitcoin specifically or cryptocurrency in general. But if you think about it, I don't know if you've even heard, like the Federal Reserve has talked about creating, a digital currency. And so I think, what you can say and can't say about cryptocurrencies is definitely limited. This is the part of your video that's going to get edited out, right? But fortunately, you're all here in the room, so you can hear my answer. So, if you think about it, what's the point of currency, right? Currency is a medium of exchange. We all started out, not we, but the human race all started out trading for things. Somebody had something that someone else wanted and they traded. And then they realized, even if you had a bunch of sheep or you had a bunch of cows or you had clothes or whatever else, you didn't always need to have that bilateral arrangement. It was really hard to find the exact right trade at the right time. So money was created thousands of years ago to be that medium of exchange and say, okay, here's the centralized amount determined by the market of whatever goods or services you're providing. You'll get a certain amount of money, and then people can take that money and go do whatever they want with it. So it's a medium of exchange. It's a store of value, right? And so, those 2 things are typically, what you're looking for. And the reason, the dollar is the reserve currency of the world right now and likely to stay that way, at least for the foreseeable future, is, first of all, we have the strongest economy in the world. And second of all, probably we have the strongest military. It's a little counterintuitive, why does it matter how good your military is? But if you think about it, all the currencies that have disappeared over the years, it's because those countries are no longer there, and typically it's through war or something else. So as long as you can preserve your country and your country will continue economically, militarily, your currency is strong. I would say people around the world are looking at our stock markets, they're looking at our bond markets, they're looking at our economy, and they're saying, either this is a place I want to, in times of stress, the dollar gets a lot stronger because people will buy treasuries and things that they think are the safest possible thing in the world, the risk-free rate. And then it's in really good boom times, they might want to invest in the United States because Google, Amazon, Microsoft, all of our great companies are doing well. So that's the reason for currencies in general. Cryptocurrency, you got to think about what are they trying to solve, right? So the first thing we want to do is they say, okay, we want to diversify away from any particular government owning a currency or being in control of it, because obviously they can print as much of it as they want and that can devalue it. So the idea was, okay, we're going to create something that's separate from any other government and also something that in theory can't be diluted. And so I think it's, I actually was a computer science major in college and I was an engineer. And so, I always thought it was an interesting experiment, but the financial side of me, the CFA side of me that knows how things work in the real world was always kind of a little curious about the idea of, exactly what are they trying to solve, right? So you could say that there's a fixed number of Bitcoins and you could never have more than that. And so therefore it could never be printed away. But what's to stop you from creating the other 10,000 cryptocurrencies that we've seen created, right? So your one argument of saying, okay, it can never be devalued because you can't create more of them, but you can create, competitors to them. So that, I feel like that kind of hits that argument. The other thing is, how would you like to be making $200,000 a year as your salary, but sometimes it's $60,000 a year, sometimes it's $400,000 a year, sometimes it's $10,000 a year. Yeah, it'd be great if it's $1 million a year. If it fluctuates so much, its utility as a currency, I think, is a lot less. So I've always really thought of cryptocurrencies as very speculative kind of assets. You could be buying baseball cards hoping they appreciate. You can buy you can buy Cabbage Patch Kids if any of you guys remember that back in the day. I'm glad I can do that with this audience. I can't do this with my children, but right. So anything can have value. Anything can appreciate in value. But if you're hoping that someone else will pay more for something that you got, just because, without any fundamental underpinning, it just seems like a risky speculation. And so that's kind of how I think about them in general. But the Federal Reserve creating a digital currency, I think, there are people who like the idea of just being able to, we went from cash to credit cards to now being able to kind of just send money instantaneously. And so there are people who want to be able to send money back and forth to each other. There's value in that. There are other countries where maybe they don't have the banking system we have. They don't have all the intermediaries that we have. Because right now we can electronically send money to each other too through Zelle or Venmo or things like that. But we have all these intermediaries. For those other countries that don't have a full banking system or don't have as much wealth, they're looking for a way to kind of cut out the banks. There's kind of some interest there. But at the end of the day, if cryptocurrency was going to be something that was untraceable and untaxable, how long do you think the United States is going to let that happen? We've already seen what happened in China, and you couldn't have two more polar opposites in terms of philosophy, but the one thing they agree on is they're going to control their currency. So for me, it'll be interesting to see how it evolves. But if I had to bet, I'd bet on the United States government and the governments of the world maintaining control of money writ large and everything else being kind of a side project. That's my educated guess, but yeah.
Great. Who's next? Any other questions? Yep, coming right. We have someone after? Great.
Hi, I was really curious with the evolution of artificial intelligence, what the implications are for the financial planning industry and maybe what you see as opportunities and risks for those of us who are in your good hands.
Thanks. Again, that computer science degree, which I'm not currently using, right, has come in handy again yet for another time. So artificial intelligence, I think, is really, really interesting. And I don't know how many of you saw the Oppenheimer movie recently, and that brings back all of the whole nuclear program and thinking about nuclear weapons and everything that came from that. It's something that really came to life to me on the screen. In a weird way, I almost think of kind of artificial intelligence as kind of that ability to create nuclear power, right? So artificial intelligence could be used to do incredible things kind of on the nuclear power side of things. And it could probably do some pretty destructive, pretty awful things kind of on the nuclear Armageddon side of things. And so I think of AI as really that powerful and that significant. Clearly we're not there yet. They're going to have to move forward. And maybe you've seen Terminator, or maybe you've seen any of these other dystopian novels, right, where the computers take over the world. That's always been really, really far-fetched, but now, as we start to get closer and closer, that's always possible. Even in the Mission Impossible movie, where the bad guy is an AI. So I think we're starting to kind of get to that point where we're starting to see the possibility of computers thinking for themselves, potentially, definitely having more control over things in the real world, which is what the threat is to us. So I'm sure it's a double-edged kind of opportunity. On the positive side of things, a lot of what I've read has been really, really interesting in terms of artificial intelligence already being able to do the equivalent of 10 or 20 years worth of drug research within 6 months. And it's only limited by computing power. So artificial intelligence could potentially open up all sorts of new discoveries in almost any field, especially along health, the human body, things like that. Back to your question about financial planning, or even maybe investing in general. I think computers are really, really interesting, and something that I literally studied and thought a lot about. And what a computer can do really, really well is do something over and over and over again, just massive amounts of time. And before we had artificial intelligence, they really would just do the same thing over and over again and go off a cliff. With artificial intelligence, there's the possibility that it can kind of learn from its mistakes. And if the environment is right, it can kind of make the mistakes in a kind of virtual world and then come up with the right answer in the future. But as long as investors are run by human beings, there's always going to be kind of that behavioral part of it. And so I've even had discussions with people who talk about, well, we should just have computers investing everything. And there are companies, there's very few of them, but that actually will run 100% computerized trading. And so what I'll always tell those people, again, because I major in computer science, I'm like, well, a human being programmed those computers, right? So there's going to be some kind of bias or some kind of decision making based on that. But more importantly, because in AI, maybe the AI could program itself, right? At the end of the day, someone can also unplug and plug in that, right? And so even the most successful electronic trading systems, the people who own them and run them make the same mistakes all of us can make, which is they just feel like it's lost too much money and they unplug it. And if they had just let it keep going, they'd make more money. So I think there's always going to be an aspect of emotion, behavioral psychology, the idea of kind of the fact that things are not linear. And so my best guess, and I'll steal this line from someone else that I heard, they said, at some point, there's going to be no person that's better than a computer at anything, right? But they said, we want to embrace this. We don't want to take this as a risk. Because they said, I guarantee you that there's going to be no computer in the future that's going to be better than a human being with a computer, right? So maybe you take the two together. And so you use human judgment, you use human insight, you use human creativity along with the power. And if you look at kind of evolution and everything that we've done, we've really used technology typically to kind of accelerate something or do something much better than we had before, productivity gains, things like that. My best guess is that's where we'll go, where we'll have, no one will be doing this from hand. They'll all have computers. But I'd be surprised if anyone decided that they want to put all of their net worth in the hands of just some computer that you can't see, right? I wouldn't want to do that. I know a lot more about computers probably than most people, and that makes me more fearful, not more trusting. So anyway, good question.
Great, I think we had a hand over here.
Yeah, I had a question on IAA, a little bit about the company and how you got started and how you grew. And also one of my concerns is over-diversification. If I bet on every team on the weekend, I'm going to be 50-50.
Right.
So you've got to eventually pick winners and get rid of the losers.
Sure.
So like some of these exchange-traded funds and stuff that basically sort of ride the market, they're basically riding a whole bunch of winners and a whole bunch of losers. So as an investment philosophy of your company, how do you invest in individual stocks or do you invest in ETFs, or what is your investment strategy? And,
sure.
And do you try to pick winners? Obviously you do, but how granular is that?
Yeah.
So
No, that's a great question. And so let's see, what's the best way to answer this? So, the investment program that I run is kind of across the board. So I have individual stock portfolios, I have ETF portfolios, I have mutual fund portfolios. And so what I try to do is, regardless of what individual underlying investments are using, the portfolio is accomplishing certain goals. And then really it's going to be up to Rick and his team and other advisors to say, I know each of you individually. I know exactly what your goals are. I know what your risk tolerance is. I know what you're trying to accomplish. I know how much money you need. I know that based on your tax situation, maybe stocks are better for you, or maybe based on what you're trying to accomplish, mutual funds or ETFs. I leave kind of that decision to the hands of the advisor on a literally client by client basis, because there's no way I could know each and every one of you or the other people that I work with. And so that's why it's so important to have a financial advisor knowing that. And then as long as a financial advisor has enough tools, and I'm really building tools for financial advisors, they can select the right tools from the shelf, put them together for you specifically, right? So the idea is that I have lots of different portfolios trying to accomplish different things. There are certain portfolios which are trying to win, and when they win, it's great, but they're more volatile, right? So for some people, that's not necessarily appropriate to really try to just get the highest possible return when there's a chance of losing, especially if it's all your life savings. But it may make sense in a certain situation for part of your money to be in that strategy. So I run strategies which are really trying to do very, very well, and trying to understand where the opportunities are, where the highest return is. And then there's other strategies that I run where I'm trying to spread the bets out a little bit. I'm never going to build a portfolio where it's just over diversified and it's just mediocre. There's really no benefit to that for any of you. There's no really benefit for me to do that. And I haven't really said this, so I'll use this opportunity. All of my own money, all of my parents' money, my brother's money, my sister and her brother-in-law, and even my mother-in-law's money are in all the strategies I run, right? So not only am I eating my own cooking, there's a lot of pressure, right? Coming to Thanksgiving or whatever else. And so, I can honestly say, I wake up every morning, I'm like, okay, how can we grow? How can we make more money? And I go to bed every night and I think about, all right, what are the risks? Where can we lose? And so what I've learned over time, and I've been doing this for not necessarily within wealth management, but working at Goldman Sachs, on Wall Street, working with partners' money, internal money as an internal trader, what I've learned is the secret to making as much money as possible is trying to lose as little money as possible. And it sounds very counterintuitive, but if you just think about it mathematically, right? If you go down 10%, you need to go up just 11% to break even. You go down 20%, you need to go up 25%. If you're down 50%, it's 100, right? Making 100% return is hard. It takes time. And so if you spend a lot of time thinking about how can you lose less money when things are down, and again, I don't run any strategies that when the market's down, well, I have one strategy, but for most part, I don't have any strategies where if the market's down, you're not down, right? Because the only strategy I've ever seen, either you have something that will not go up at all when the market goes up, but also doesn't go down, or there are strategies where there's somewhere in between. And really it's best to kind of optimize, can you make as much as you can on up times, but kind of limit the downside. And limiting the downside is really important, right? I mean, the only portfolio I've ever seen that only goes up, never goes down, in down markets, up markets is Bernie Madoff's strategy, which if you ever see anybody who can do that and they win all the time, I would think it's not real, right? Because no one can do that. So, but yeah, great question.
Great, we got time for one more question. I'll just be respectful of everyone's time. Okay.
Thanks again. Good information. Really appreciate it. So I'm going to take a little turn here. I'm a federal employee, so by the way, thank you everybody for paying your taxes. I appreciate that. So I'll have money that goes into the TSP.
Sure.
And just curious, it seems like it's great. It always seems like it gets higher returns than most other. I think it mirrors the S&P for the most part. Mm-hmm. But just generally, what are your thoughts about that? Is it a good investment, fair investment, or what?
Yeah. So the TSP program it's kind of like a 401k for government workers. And so, I think you could have even had that if you were in the military too. You don't just have to be, a typical government worker. So, I mean, it's a really good plan in the sense of a great 401k plan, right? So It's going to be probably very diversified. It's going to have very low cost investments. And so, there's nothing wrong with that. I don't think, I don't think there's anything that is going to cause you issues. The problem is you've got to pick all your own investments yourself, right? You have to figure out what the right mix is. And the investment options are limited. So for me, that's not something that I would personally want, because I want to be able to kind of control what I'm investing in, how I'm investing in it, and what the different allocations are. But generally speaking, I'm investing IRAs, or I'm investing after-tax accounts. I'm not investing 401k plans either. So for those people who have a 401k plan, maybe it makes sense to always keep it. Maybe it makes sense to roll it to an IRA. That really depends on your specific situation, what you're trying to accomplish. What are your goals, things like that. Definitely a conversation with an advisor, not necessarily with me. But just at a high level, there's nothing wrong with it. It's just you have to know the choices are limited, and there's a lot of diversification. But the best thing about it is it's very low fee. So all things being equal, at least whatever it is you're doing, you're getting the maximum out of that. So yeah. Mm-hmm.
Well, Chris, first of all, very well balanced, very, very direct. We really appreciate you. Let's give Chris a round of applause.
Thank you.
On behalf of Rick and the team, we want to thank you all for coming. We really, those of you clients, we appreciate you being clients. Those of you who aren't clients yet, stick around, get to know us, get to know the team. Definitely go to the website if you haven't seen the video series yet. Rick and his team have done a great job. There's 8 videos. They're short, 6, 7, 8 minutes. You'll learn more in that time, under 10 minutes, than from me, that I've learned in years of talking to other people. So definitely go check it out. It's called Retirement Income Planning Series. And stick around, eat, drink, be merry. We appreciate you.